And we are live. Hey guys, welcome back to the stream. Good morning, everyone. Yeah, today it's today I was late. There is a reason. I woke up like very late. I didn't wake up at 3. Woke up like half an hour ago only. Yeah, there was a. I don't know. I was not tired. I don't know. I was why I woke up late. You know what? I know. I know why I woke up late. Okay, so I said in the Discord, if you are there in the Discord, you already know this. So, two of our channels have been obliterated by YouTube. So, yeah, I was a bit sad about that. I mean, I knew it was coming, right? But still, it just suddenly just it's gone. It's just gone. So, Mind Mania Master, right? That channel. Uh, there is actually a reason why I stopped streaming in that. It's because of this problem only. I mean, I knew something would happen. Then Game Hell was gone before that, but I got it back. Then it went again, and now this is also gone. And I'm saying all this because this Genu Live, right? This also has a chance of going. I mean, it's possible. So I suggest you guys follow me on Rumble. Rumble, you know, like, it's a good thing, right? So in this, like everything, it's already there. Like all the things which we've been doing from the beginning. So Rumble is like can be for like a permanent, permanent thing, permanent base. Yeah. So you guys follow me here. Go to I'll put the link. 1 minute. I'll put it in chat. So yeah, just in case, follow me there also. That's fine. Yeah, this is the reason I've been saying, right, from the beginning. Even for Twitch also, there is a good chance. I don't know, like something can happen, right? Which is like randomly banning people. So it's always good to have backups. So this is the reason I've been saying the last time, right, with the Gasters, I was saying I don't give a fuck if I get banned because I already got banned like multiple times. So I was like, okay, now at this point, I mean, a person can only give so much fucks before like like okay, I don't give a fuck. Yeah, I've reached that point. Okay, good. So guys, now that I've told you all that, let's get back to our chapter. Okay, yeah. I'm sleepy. You know, I've completely stopped drinking tea. Oh, there's another thing. Yesterday I was having like headaches. You know, like the coffee headache, right? Now, if you don't have coffee at the right time, you will get headache. It's like the withdrawal symptom for coffee. I was having like headache. I was like, okay, now I went through it. I didn't have coffee. I didn't cave. I was strong, guys. I was strong. Yeah, examples of debt-free money systems in existence. Case studies. So Vogel experiments. We read about that. The Guernsey experiment also we've completed, right? Okay, so the third one is Chiemgauer. Chiemgauer, a study of a regional currency system in Germany that aims to promote local economic development and sustainability. Okay, I'm pretty sure I'm butchering the name, but let's write it. No. You see the spelling and you let me know how do you spell it. Yeah, this is the thing. Chiemgauer. Okay. Chiemgauer is a regional currency system that was launched in 2003 in the Chiemgau region of Germany. The currency was created to promote local economic development and sustainability by encouraging the circulation of money within the local community. The Chiemgauer operates alongside the euro and can be used in local businesses and shops that have signed up to the system. One of the unique features of Chiemgauer is that it is issued as a debt free currency. The local government acts as the issuer of the currency and uses it to pay for public services and infrastructure projects. The Chimgaur is backed by the value of the services provided by the local government and it can only spend within the region. This helps to ensure the money stays within the local community and supports local businesses and services. The Chimgaur is the Chimgaur has been successful in promoting local economic development and sustainability. Since its launch, the currency has been adopted by over 600 businesses and has circulated over 6 million chingo. The system has also helped to create a sense of community in the region and has encouraged people to shop locally and support local businesses. However, there have been some challenges associated with the Chimga. Critics argue that currency may lead to higher prices for consumers. Timothy Kyle Gaming. Hey, what's up, man? Good morning, bro. Hello, I have a question. Yeah, bro, tell. What's up? How's life? Hey, did you see it in the Discord? Bro, we lost the channel, man. Game Hell Live and Mind Many Masters also gone. So Game Hell Live was gone before, right? And Mind Many was just still there. Then we got Game Hell Live back. Now both are gone. Both are gone. Even this will go. This channel will go eventually. So yeah, follow me on Rumble, man. Follow me on Rumble. Okay. Uh, However, there have been some challenges associated with the Chimgar. Critics argue that local currency may lead to higher prices for consumers and that it may not be as efficient as euro. Before the question, what is the game channel is gone? Yeah, man, the game channel is gone, man. The game channel is gone. YouTube nuked it. Wait, I'll show you the mail. Hola, hey, Mr. Sun X, Mr. Fun. Hola, Mr. Sun X. I don't wanna whine about it, but still, like it's a bit, it's sad, right? It's sad. All the work we've done so far is gone, bro. Okay, so this is the mail I got. So this is the mail I always get, right? Okay, when I say I always get, this is not the first or second time the channel which I made I've gone. So yeah. So this is the mail I got. It says you can't see it, right? Can you see it now? Yeah, as you know, please live. They have reviewed your content found severe repeated violations. Same bullshit. Like there is no particular thing. They won't say because of this, because of that. Okay, see, the channel didn't have any strikes or warnings or anything, so it's not the content. I don't know. I mean, I really don't know the reason. See, all the time it happened, right? They won't particularly say. If let's say all the memories of channel, no, it's there. That's the thing, right? Tim, it's fine. It's all there. It's all there. It's all there in Rumble, right? So in Rumble, right? It's a good thing I've made like backups. So in Rumble, both the channel are there. Mind Mania Master and Game High Live are there. It's all there. It's all there. Don't worry, bro. Yeah, I said this in the channel, in the uh, Discord. Yeah, all of this is there. All of this is there. So it's fine. Even Mind Mania Master, it's all there. Good, right? Yeah. So Rumble, guys, Rumble. Even for this one, even for Genu Live, right? Yeah, it's good. It's better to follow me on Rumble because, yeah, YouTube, anything can happen, man. Anything can happen. Yeah, yeah. I mean, I knew this, bro. I knew this. I knew this was coming, right? So it's fine. Yeah, Tim, you also, right? Go to uh Genu Live, bro, on Rumble. I don't have my uh URL reserved. I think if I get like some more followers, I think I can get the reservation for the thing, for the URL. When I say reservation, the name, right? The name. So for My Mini Master, the channel URL have my name, but for Live and others, I don't have. I think it's because of the number of subscribers, not subscribers, followers. Yeah. So guys, follow me, follow me, follow me, follow me. Yeah, follow me so that we can get a proper URL. Fine. Okay. Yeah, Tim, what was your question, man? You were about to ask a question. Okay, meanwhile, I'll just read this. Fine. Yeah, the challenges associated with the Chimgao. Critics argue that the currency may lead to higher prices for consumers and that it may not be as efficient as the euro. Nevertheless, it has demonstrated that local currency systems can be effective tools for promoting local economic growth and sustainability. Okay, the next one is British, or not British, Bristol Pound, a case study of a local currency system in UK that promotes independent businesses and community resilience. The Bristol pound is a local currency system that was launched in the UK city of Bristol in 2012. The currency was created to promote independent businesses and encourage local spending, thereby increasing community resilience and economic sustainability. The Bristol pound is issued by the Bristol Pound Community Interest Company, BPCIC. they, they didn't give the acronym, I just gave it. British Pound Community Interest Company, BPCIC, which is a non profit organization that manages the currency and promotes its use. One of the key benefits of Bristol Pound is that it encourages people to shop locally, thereby supporting independent businesses and reducing the environmental impact of transportation. The currency can be used to purchase goods and services from over 800 participating businesses in Bristol, including cafes, restaurants, shops, and service providers. The currency can be obtained by exchanging British pounds at designated locations or by receiving payment in Bristol pounds for goods and services provided. In addition to promoting local spending, the Bristol Pound also aims to increase community engagement and foster a sense of civic pride. The currency features designs that celebrate the city's cultural heritage and local landmarks. And the Bristol Pound Community Interest Company hosts events and activities to promote the currency and encourage community involvement. Overall, the Bristol Pound is a successful example of a local currency system that promotes economic sustainability, community resilience, and independent businesses. The currency has been adopted by many businesses and individuals in Bristol and has helped to strengthen the local economy and build a more connected and engaged community. Okay, that was the Bristol pound. Okay, you know what? Let me just note down all the different debt free systems that exist. The first one was the Vogel experiment. Vogel, Vogel experiment. The second one was the Guernsey experiment. Where? No, no. This was the first one. This was the second one. This was the third one. And the fourth one was Bristol pound. And the next one is the Ithaca hours, a case study of a time-based currency system in New York City, no, not New York City, New York State that seeks to promote local economic self-sufficiency and reduce income inequality. Ithaca hours, not Ithaca, Ithaca, Ithaca. The Ithaca Hours is a local currency system that was established in 1991 in Ithaca, New York State. It is a time based currency where 1 hour of work is equal to 1 Ithaca hours, regardless of the type of work done. The Ithaca hours is used by over 900 individuals and businesses in the area and is aimed at promoting local economic self sufficiency and reducing income inequality. The currency was developed by Paul Glover, who saw the need for a system that would allow people to exchange goods and services without relying on national currencies that are subject to inflation and economic fluctuations. The Ithaca Awards has been successful in promoting local businesses and creating a sense of community ownership, with many residents choosing to shop and do business locally instead of going to chain stores and businesses. One of the key benefits of the Ithaca Hour system is that it helps to reduce income inequality by allowing people to earn and spend local currency regardless of their financial status. This means that people who may not have a lot of money can still participate in the local economy and contribute to their community. Additionally, because the currency is time based, it encourages people to value their time and skills rather than their ability to earn and spend money. The success of the Ithaca has inspired similar time-based system in other communities around the world, and it continues to be a model for local economic development and sustainability. The next one is The Bitcoin. Yeah. It's not Bitcoin, man. It's the Bitcoin. No, I don't know. In the title, they've said it like the Bitcoin. Case study of a decentralized digital currency system that challenges traditional monetary system and has potential implications for global financial systems. Bitcoin is a decentralized digital currency that operates independently of any government or financial institution. It was created in 2009 by an anonymous person or group using the pseudonym Satoshi Nakamoto. The Bitcoin network is based on a peer to peer system, which means that users can transact directly with each other without the need for intermediaries. Bitcoin has gained widespread popularity and has become one of the most valuable digital currencies in the world. It often it is often hailed as a revolutionary technology that challenges traditional monetary systems and has the potential to disrupt the global financial system. One of the main advantages of Bitcoin is its decentralization, which means that no single entity controls it. Transactions on the Bitcoin network are verified by a network of computers known as nodes, which are spread across the world. This means that Bitcoin transactions are secure and cannot be manipulated by any single entity. Another advantage of Bitcoin is its transparency. All transactions on the Bitcoin network are recorded on a public ledger called the blockchain, which allows anyone to view and verify them. This means that Bitcoin transactions are more transparent than traditional financial transactions. However, Bitcoin is not without its drawbacks. One of the main criticisms of Bitcoin is its high volatility, which can make it difficult to use as a stable store of value or medium of exchange. Additionally, Bitcoin has been associated with illegal activities such as money laundering and illicit transactions due to its anonymity. Okay, just because it said, you know what else is being used for illegal activities such as money laundering and illicit transactions? Cash. Like 99% is through cash and 1% is through Bitcoin. I just want to make it clear. Overall, Bitcoin represents a new paradigm in monetary systems and has the potential to transform the global financial landscape. However, its full potential and long term impact on the economy are still uncertain. The next one is the Bangla Pesa. Bangla Pesa. Oh, is it like related to Bangladesh? Bangladesh, yes, yes, it is. Bangla Pesa. The Bangla Pesa is a community currency system that was established in 2010 in the informal settlement of Bangladesh in Kenya. Informal settlement of Bangladesh in Kenya. Okay, the Bangla people have gone to Kenya. Yeah, I mean, yeah, like basically Indian, yeah, Indian subcontinent people, yeah, they are everywhere, man. I mean, like we are everywhere. The system was okay. The informal settlement, I don't know about that part, but maybe the Kenya people don't recognize us or I don't know. The system was created by community members to address the issue of poverty and lack of access to credit in the area. The Bangla Pesa operates as a complementary currency system, which means that it is used in addition to the national currency, the Kenyan shilling. The Bangla Pesa operates on a mutual credit system where participants exchange goods and services using Bangla Pesa credits instead of the Kenyan shilling. The system allows for members to borrow and lend Bangla Pesa as long as they maintain a positive balance in their account. The Bangla Pesa is backed by the productivity of its members, who are required to offer goods and services in exchange for Bangla credits. The system has been successful in providing access to credit for small businesses and promoting economic growth in the area. The Bangla has also helped to reduce poverty by providing a means of exchange for basic goods and services. And by promoting local economic activity, the system has expanded to other informal settlements in Kenya and has been recognized as a model for community currency systems in other parts of the world. However, the Bangla has faced challenges such as resistance from local authorities and lack of acceptance from some members of the community. Despite these challenges, the system has continued to operate and has demonstrated the potential for community currency systems to promote economic development and reduce poverty in marginalized communities. So, these were the different debt free systems in existence. The next is chapter 13, a new economic model, principles and components. And my photic sneeze reflex is kicking in, guys. You can feel that, right? Like in my voice, my nose is like closed. I'm actually speaking, not speaking through my nose. Like I can't breathe properly. What is this? Principles and components. Okay, so this is not like a definitive, it's like theory, right? It's like theory, same as communism. I'm not saying it'll work, it may not work, but in paper it sounds good. So this one is also has some similarities with the existing systems and some components and principles from existing system. But I'm saying it's not tested or proven. So yeah, the need for a new economic model, criticisms of the current system and challenges ahead. The current economic system is facing various criticisms, and the need for a new economic model is becoming more urgent. One of the primary criticisms is the increasing income inequality that is creating a gap between the rich and the poor. The top 1% of the world population holds over 50% of the world's wealth, while the bottom 50% hold less than 1%. This disparity is leading to social unrest and political instability in many countries. Another criticism is the negative impact of economic growth on the environment. The current economic model relies heavily on fossil fuels and other non renewable resources, leading to climate change, pollution, and environmental degradation. The degradation of natural resources and economic and ecosystems is also threatening food security, public health, leading to economic challenges. Further, the current economic system is failing to address the root cause of poverty and social exclusion, leading to increasing social disparities, migration, and conflicts. The current system focuses primarily on maximizing profits and shareholder value, neglecting the social and environmental costs of production and consumption. The challenges ahead are also daunting. The current system is facing the pressures of demographic shifts, technological advances, geopolitical instability, and resource scarcity. These challenges require a new economic model that is more inclusive, sustainable, and resilient to address these emerging issues. Principles of a new economic model, values and objectives to guide the design and implementation of a new system. The principles of a new economic model should be guided by values and objectives that prioritize the well being of people and the planet over profits and growth. These principles should be grounded in a deep understanding of ecological and social systems and the complex relationship between them. Here are some key principles that could guide the design and implementation of a new economic model. Sustainability. The new economic model should be based on sustainable practices that promote conservation and restoration of natural resources, ecosystems, and reduce the carbon footprint of economic activities. Equity. The new economic system should prioritize equity and social justice, ensuring that everyone has access to essential goods and services, regardless of their income or social status. Participation. The new economic model should be inclusive, allowing all stakeholders to participate in decision making processes and have a say in how resources are allocated. Resilience. The new economic model should be resilient, able to adapt to changing social, economic, and ecological conditions and withstand shocks and disturbances. Diversity. The new economic model should promote diversity and creativity, fostering a range of innovative ideas and approaches to economic development. Regeneration. The new economic model should aim to regenerate natural resources, social systems, creating new opportunities for ecological and social restoration and healing. Localism. The new economic model should promote local self sufficiency and community resilience, reducing dependence on global supply chain and fostering local economic development. These principles should could help guide the development of a new economic model that is more sustainable, equitable, and resilient, and better aligned with the needs and aspirations of the people and the planet. Components of a new economic model, key elements and features that could replace or complement existing structures and mechanisms. A new economic model should incorporate key components that can either replace or complement existing structures and mechanisms. These components include decentralization. A new economic model should be decentralized, allowing for greater participation and input from communities, businesses, and individuals. This would require a shift away from centralized decision making and towards more democratic and decentralized systems of governance. Localism. The new economic model should prioritize local economic development, promoting the production and consumption of goods and services within local communities. This would require the creation of local currencies, decentralized production systems, and community based ownership models. Social and economic sustainability. A new economic model should prioritize social and economic sustainability over long term profits. This could require that adoption of sustainable production and consumption practices, the protection of natural resources, and the reduction of waste and pollution. Economic democracy. A new economic model should prioritize economic democracy, allowing workers, consumers, and communities to have greater control over the means of production, distribution, and exchange. This would require the adoption of democratic ownership models, such as cooperatives and community owned businesses. Redistribution of wealth and resources. A new economic model should prioritize the redistribution of wealth and resources, reducing inequality and promoting social justice. This would require progressive tax systems, social welfare programs, and creation of public goods and services. By incorporating these components, a new economic model can prioritize sustainability, democracy, and social justice over short term profits and growth. Systemic changes. Transformations needed at the local, national, and global levels to ensure the success of a new economic model. The need for systemic changes is an important aspect of any new economic model that seeks to address the challenges and criticisms of the current system. These changes need to happen at local, national, and global levels in order to ensure the success of new economic model. At the local level, communities need to be empowered to take more control of their economic systems. This can be done through the establishment of local currencies, community owned businesses, and cooperatives. These initiatives can promote greater economic resilience, reduce inequality, and support sustainable development. At the national level, there needs to be a shift towards a more diversified and sustainable economy that is less reliant on GDP growth as the primary measure of success. This can be achieved through policies that promote local production, protect natural resources, and support social welfare programs. At the global level, there needs to be a greater focus on international cooperation and coordination to address the challenges of inequality, environmental degradation, and financial instability. This can be achieved through the establishment of new institutions and mechanisms for global governance that are more democratic, transparent, and accountable. Overall, the systemic changes needed to support new economic model will require a fundamental shift in the way we think about and approach economic development. It will require bold and innovative policies that prioritize the well-being of people and the planet over short-term profit and growth. Governance and accountability, structures and processes that ensure the participation and oversight of all stakeholders and prevent abuses of power and corruption. Governance and accountability are crucial components of a new economic model that prioritize sustainability, equity, and justice. The current economic system is often criticized for its lack of accountability, which allows powerful actors to exploit resources, evade taxes, and engage in corrupt practices without facing consequences. To address these challenges, a new economic model should adopt governance and accountability structures and processes that promote transparency, participation, and oversight by all stakeholders. One key principle for governance and accountability in a new economic model is the recognition of the rights of all people and the environment. This includes the rights of future generations to access natural resources, the right of workers to decent working conditions and fair wages, and the rights of communities to participate in decision making processes that affect their lives. To achieve these goals, a new economic model should promote multi stakeholder participation in governance and decision making processes, including the participation of marginalized groups such as women, indigenous communities, and small scale farmers. The new economic model should also adopt transparent and participatory budgeting processes that ensure public resources are allocated in ways that promote equity and sustainability. Another key component of governance and accountability in a new economic model is the establishment of effective regulatory frameworks and enforcement mechanisms. This includes regulation to prevent corruption, enforce environmental protections, and ensure fair competition in markets. Effective enforcement mechanisms should include independent oversight bodies with clear mandates and power to investigate and sanction violations. Ultimately, governance and accountability structures and processes should ensure that new economic model operates in a transparent, participatory, and sustainable manner that serves the needs of all people and the environment. Sustainability and resilience. Strategies that promote economic growth and development that are compatible with environmental and social goals. Sustainability and resilience are critical components of a new economic model that prioritizes the long term health of both society and the planet. One strategy to achieve sustainability and resilience is to shift away from a linear take, make, dispose model of production and consumption to a circular model emphasizes recycling, reusing, and repairing resources. This could involve designing products with a focus on durability and repairability, as well as implementing policies and incentives that encourage consumers to adopt more sustainable lifestyles. Another strategy is to prioritize renewable energy sources such as solar, wind, and hydroelectric power over fossil fuels. This can reduce greenhouse gas emissions, promote energy independence, and stimulate the growth of sustainable industries. Additionally, it is essential to protect natural resources such as forests, oceans, and freshwater systems, which provide vital ecosystem services such as air and water purification, climate regulation, and habitat preservation. In terms of resilience, the new economic model should prioritize local and regional self sufficiency to reduce dependence on global supply chains that can be vulnerable to disruptions. This could involve promoting local agriculture, supporting small and medium sized businesses, and building resilient infrastructure that can withstand natural disasters and other shocks. It is also crucial to invest in education and training programs that prepare individuals and communities for the challenges of a rapidly changing economic and environmental landscape. Innovation and creativity. Harnessing the potential of new technologies, business models, and social movements to create new opportunities and solutions. Innovation and creativity are critical components of a new economic model as they are necessary for creating new opportunities and solutions that address the challenges of the current economic system. New technologies, business models, and social movements have the potential to revolutionize the way we live and work, and they can be used to create more sustainable and equitable economic systems. One example of innovation in the economic sector is the rise of decentralized and peer to peer platforms such as blockchain based systems, which offer new models for finance, governance, and exchange. These platforms can be used to facilitate decentralized decision making, reduce transaction costs, and increase transparency and accountability. Another example is the growth of the sharing economy, which is based on the idea that sharing resources and services rather than owning them outright. This model has great potential to reduce waste, increase efficiency, and promote community resilience. In addition, social movements and activism can drive innovation by pushing for change and highlighting the need for new solutions. For example, the climate justice movement has spurred innovation in the development of renewable energy technologies. Yeah, my nose. I need to go and wipe my nose. I'll be back. Just remember this. Overall, innovation and creativity are essential for building a new economic model that is more equitable, sustainable, and resilient. By harnessing the potential of new technologies, business models, and social movements, we can create a prosperous and just for all. Equity and justice, ensuring fair distribution of resources, opportunities, and rewards across different groups and regions. So it just made it worse, man. What the hell? Achieving equity and justice is a critical aspect of a new economic model. The current economic system has led to widening inequalities in income and wealth, resulting in social and political unrest. Therefore, a new economic model must aim to create a more equitable and just society by addressing these imbalances. One of the key strategies to achieve this is to promote the distribution of resources, opportunities, and rewards across different groups and regions. This can be done through progressive taxation, universal basic income, and other forms of social protection that ensure access to basic goods and services for all. Additionally, policies that support the growth of small and medium sized enterprises can help create more local jobs and reduce inequalities between different regions. A new economic model must also strive to reduce discrimination based on gender, race, ethnicity, and other factors. This can be achieved by creating a level playing field through policies that promote equal access to education, training, and employment opportunities. Additionally, promoting diversity and inclusivity in decision making process can help address systemic biases and promote more equitable outcomes. Overall, a new economic model must be guided by principles of equity and justice, ensuring that everyone has access to the resources, opportunities, and rewards needed to lead a fulfilling life. Education and culture, promoting awareness, knowledge, and skills that are essential for the success of the new economic model. Education and culture plays a crucial role in the success of any economic model. A new economic model that aims to create a fair and sustainable society needs to promote awareness, knowledge, and skills that can help individuals and communities to become active participants in shaping their economic environment. This requires a shift in the current educational paradigm, which mainly focuses on the acquisition of technical skills and knowledge that support the dominant economic system. A new economic model should prioritize education that fosters critical thinking, creativity, and social responsibility. This education should include a holistic understanding of the economy, its impact on society, and the environment. It should also encourage lifelong learning and provide opportunities for individuals to engage in cooperative and community based learning experiences. Cultural values also play a crucial role in shaping economic behaviors and practices. A new economic model should aim to promote cultural values that support sustainability, social justice, and cooperation. This requires a shift away from individualistic and consumerist values towards more collective and community oriented values. Promoting education and cultural change requires the involvement of diverse stakeholders, including educational institutions, civil society organizations, and government agencies. These stakeholders can work together to create new educational programs and cultural initiatives that support the principles and objectives of the new economic model. Global cooperation, building partnerships and networks that enable knowledge sharing, trade, and development across borders and regions. The final component of new economic model is global cooperation, which emphasizes the importance of building partnerships and networks that enable knowledge sharing, trade, and development across borders and regions. In an interconnected world, it is essential to acknowledge that no country or region can address global challenges alone. Cooperation between nations and international organizations is necessary to promote shared values and objectives, such as reducing poverty, promoting human rights, and protecting the environment. The new economic model must recognize the importance of inclusive economic and development development that benefits all countries and regions, regardless of their economic and political power. This requires policies and strategies that address the root causes of inequality and create opportunities for everyone to participate in the global economy. One example of global cooperation is the United States Sustainable Development Goals, or SDGs, which are universal call to action to end poverty, protect the planet, and ensure that all people enjoy peace and prosperity. The SDGs provide a common framework for countries, international organizations, civil society, and the private sector to work together to achieve these objectives by 2030. Another example is international trade arrangements that promote fair and equitable trade practices, reduce barriers to entry for small and medium sized enterprises, and encourage the sharing of knowledge and technology. Such agreements can create a level playing field for businesses across different countries and regions, leading to increased economic growth and development. In summary, global cooperation is essential for success of a new economic model. It requires a shared commitment to promoting inclusive economic growth and development, reducing inequality and addressing global challenges through partnerships and networks that enable knowledge sharing, trade and development across borders and regions. My nose, man, my nose. Because I'm dying. Is it like the hey, will it change if I make change the light? You know, make it like more red light. So this one, right? This one is warm light, this one is regular. So I'm thinking if I make both warm, will it change? I can't take it, man. Every time I stream, why? 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 You know, I had this disdain towards people who say they have allergies. I was like, how did how did evolution not take care of this thing till now? But now I am having allergy to light. What is this? What the hell is this? Allergy towards light. It's pathetic. Why the evolution has not taken care of this? Okay, now when I mean like why evolution has not taken care of it, I mean my ancestors who were uh, allergic to light should have died off. Not. No, it's bad to say. No, why did they have to pass on these genes? That's what I meant to say. Oh my god, my eyes are watering up. No, it is the light. Right, for sure it's the light because the rest of the day, right? The rest of the day I'm here or even outside. Outside light is also fine. That's another thing. Like when I go out in the sun, that light is fine, huh? But only this light is the problem. I don't know why? Why? Uh, yeah, and when I turn off the floodlight for the stream, like basically when I stop streaming, the problem is gone. Ah, hate it. I hate it. Cooling glass, huh? I don't have cooling glass, but I have 3D glass. Cooling glass. I went to search. I didn't find it. It's somewhere. Like I have a Ray-Ban somewhere lying around. I don't use it that much, right? So I think now I have a reason to use it. I can read, but I don't know whether it's gonna reduce the problem or I don't feel like the problem is going on. No, it's making it worse. It's making it worse. It's making it worse because I don't know, maybe like some dust, some problem. Ah. I have like a bunch of 3D glasses, like from a movie which we went to see, like with family. Everyone will get the disposable glass, right? Yeah, we didn't dispose it. I collected it. I have it here. So it's the polarizer. So it's fun to not fun, but it's interesting to play. It's a what is it? It's a scientific phenomena, right? Like the polarizing of light. Yeah. Hmm. Ah, okay, chapter 14. Gold standard and its historical significance. Yeah, we discussed about it, the history part. We already discussed in the other book, but this is like an independent book, right? So I thought I'll mention it here also. The concept and history of gold standard, definition, origin, and development. The gold standard is a monetary system where the value of the country's currency is pegged to a fixed amount of gold. Under this system, the government promises to exchange its currency for a fixed amount of gold on demand, making the currency convertible into gold with a fixed price. The gold standard emerged as a response to the need for a stable and predictable currency that would promote trade and economic growth. The first recorded use of gold as a medium of exchange date back to ancient civilizations such as Egypt and Mesopotamia. However, the modern gold standard began to take shape in the late 19th century, which with countries such as Britain, France, and Germany adopting it as a means of stabilizing their currencies. During the classical gold standard era from 1870 to 1914, the gold standard became the dominant monetary system in the world, with most major economies pegging their currencies to gold. This period was characterized by stable prices and low inflation, as the gold standard prevented governments from inflating their currencies by limiting the money supply to the amount of gold held in reserve. However, the gold standard's rigid rules also made it inflexible in times of economic crisis, as countries could not stimulate their economies by printing more money. The gold standard history is a complex and nuanced one with different variations and levels of success in different time periods and countries. Its development and eventual decline continue to shape discussions about the role of gold in the modern monetary system. The pros and cons of gold standard, benefits and challenges of having a fixed exchange rate system based on gold. The gold standard is a monetary system where the value of currency is fixed to a certain weight of gold. There are advantages and disadvantages to using the gold standard. One of the advantages of the gold standard is that it provides stability in the monetary system. The value of currency is linked to a tangible asset, which means that the supply of money is limited by the availability of gold. This limits inflation and ensures that the purchasing power of money remains relatively stable over time. Another advantage of gold standard is that it provides a clear framework for international trade. Countries can use gold as a benchmark to determine the value of their currency in relation to other currencies, which makes trade and investment more predictable and stable. However, there are also disadvantages to gold standard. One of the main challenges that it limits the flexibility of monetary policy. Central banks cannot adjust the money supply to respond to changes in the economy, which can make it difficult to stabilize employment and output during economic downturns. Another challenge is that the supply of gold is limited, which means that economic growth is also limited. The gold standard can constrain economic growth by limiting the money supply, which can lead to deflation and a decrease in demand for goods and services. In summary, while the gold standard provides stability and predictability in the monetary system, it also limits the flexibility and monetary policy and can constrain economic growth. The classical gold standard, its features, strengths, and limitations in the 19th and early 20th centuries. The classical gold standard, also known as international gold standard, was a monetary system that prevailed from the late 19th century to the outbreak of World War I. Under this system, national currencies were convertible into gold at a fixed rate. The value of each currency was determined by amount of gold reserves held by its central bank. The main strengths of the classical gold standard were its stability, predictability, and credibility. By linking currencies to a scarce and valuable commodity like gold, it prevented excessive inflation and maintained confidence in the monetary system. This in turn facilitated international trade and investment as it eliminated the uncertainties and risks associated with currency fluctuations and devaluations. However, the classical gold standard also had limitations and challenges. One of the main limitations was that the amount of gold available in the world limited the supply of money, which in turn could limit economic growth. Moreover, countries with large gold reserves had a disproportionate influence on the international monetary system, leading to concerns about power imbalances and economic nationalism. Finally, the rigidity of the fixed exchange rate system made it difficult for governments to respond to economic shocks and adjust their policies accordingly. These limitations ultimately contributed to the collapse of the classical gold standard and the emergence of alternative monetary systems. The interwar period. The collapse of the gold standard and its impact on the global economy during the Great Depression. The interwar period saw the collapse of the gold standard, which was a major factor in the economic instability of the time and the subsequent Great Depression. The gold standard had been weakened by the massive costs of World War I and the post war reparations imposed on Germany, leading to an unsustainable amount of debt and inflation. In addition, countries began to lose confidence in each other's ability to maintain a fixed exchange rate system based on gold, leading to devaluations and a flight of gold reserves. United States, which had become a dominant economic power in the world, was forced to shoulder the burden of the gold standard, and the pressures of maintaining a fixed exchange rate became too great. In 1931, British government abandoned the gold standard, which caused a panic in financial markets and led to a wave of bank failures and economic contractions around the world. The collapse of the gold standard had significant impacts on the global economy. including a reduction in international trade and mass unemployment, and the decline in economic growth. It also led to a revaluation of economic policies and theories, with economists such as John Maynard Keynes. Yeah, he came up with the Keynesian theory, arguing for more active role of governments in managing the economy. Ultimately, the interwar period demonstrated the limitations and dangers of a fixed exchange rate system based on gold, and paved the way for development of alternative monetary systems. The post World War II gold standard. The Bretton Woods system, its functioning and its decline in 1970s. The Bretton Woods system, I don't know, some dust or something is there on the mic. The Bretton Woods system was established in 1944 and represented a new form of gold standard. Under the system, US dollar was fixed to a gold at a rate of $35 per ounce. Oh, I wish. Oh, $35 per ounce, man. Shit. And wait, what is it today? Today, what is the gold price? Gold price, dollar per ounce. Aussie ounce, right? 2800. Nice. Okay. Now, the system provided a stable and predictable international monetary system, which helped to facilitate international trade and investment. However, the system faced several challenges that eventually led to its decline in 1970s. One of the main challenges was the growing US trade deficit and the corresponding increase in the amount of US dollars held by foreign central banks. This led to concerns about the US government's ability to maintain the fixed exchange rate, as it became clear that the US did not have enough gold reserves to back all the dollars in circulation. This was exacerbated by increasing costs of Vietnam War, which put pressure on the US balance of payments. In 1971, President Nixon suspended the convertibility of the US dollar into gold, effectively ending the Bretton Woods system. This led to a period of floating exchange rates where the value of currencies was determined by market forces. While this allowed for greater flexibility in monetary policy, it also led to greater volatility in exchange rates and increased uncertainty in the international financial system. Overall, the Bretton Woods system represented an important attempt to create a stable and predictable international monetary system based on the gold standard. However, its decline highlighted the challenges of maintaining such a system in the face of changing economic conditions and shifting global power dynamics. The resurgence of gold as an alternative to fiat money. The gold bugs movement, its arguments, and its impact on monetary policy. In recent years, there have been a resurgence of interest in gold as an alternative to fiat money, leading to the emergence of the gold bugs movement. Supporters of gold standard argue that gold has unique properties that make it an ideal currency, including its durability, scarcity, and resistance to inflation. Goldbergs believe that Goldbergs believe that fiat money, which is not backed by a physical commodity like gold, is prone to manipulation and devaluation by governments and central banks. They argue that a return to the gold standard would restore confidence in the monetary system, promote fiscal discipline, and limit the power of central banks to engage in monetary policy. However, critics of the gold standard argue that It has several limitations and would be impractical in a modern global economy. One major challenge is the limited supply of gold, which would make it difficult to expand the money supply to support economic growth. Another issue is that the price of gold is subject to significant fluctuations, which could lead to destabilizing deflationary or inflationary shocks. Overall, the gold bugs movement has raised important questions about the role of gold in the global monetary system. It remains a controversial and unlikely solution to the challenges of modern monetary policy. The contemporary debate on gold standard, the pros and cons of reintroducing it as a monetary system, and the challenges of implementing it in a globalized economy. The debate over reintroduction of gold standard as a monetary system is ongoing, with some advocating for its return as a way to anchor currency values and promote financial stability. Proponents of the gold standard argue that it would prevent governments from engaging in inflationary monetary policies and that it would provide a stable and predictable currency value for international trade. However, critics of the gold standard point out that it is a rigid system that does not allow for necessary flexibility in monetary policy during economic downturns. Additionally, it could limit government's ability to respond to challenges through stimulus spending or other measures. Another challenge to implementing the gold standard in a globalized economy is the question of how to handle gold flows between countries, particularly as they relate to trade imbalances. It is unclear how countries would be able to maintain gold reserves and adjust their currency values accordingly in such a scenario. Overall, the debate on gold standard remains contentious, with both sides presenting valid arguments for and against its reintroduction as a monetary system. It is important to carefully consider the potential benefits and drawbacks before making any significant changes to the current monetary system. The impact of the gold standard on international trade, investment, and economic growth. Historical evidence and contemporary debates. The gold standard had significant effects on international trade, investment, and economic growth. Under the gold standard, countries with trade surpluses accumulated gold reserves, while countries with trade deficits experienced a decline in their gold reserves. The gold standard also promoted international investment by providing a stable and predictable exchange rate system that reduced currency risk. However, the gold standard also limited the ability of countries to pursue expansionary monetary policies, which could have negative effects on economic growth. The historical evidence on the impact of gold standard on economic growth is mixed. While some argue that gold standard helped to promote economic stability and growth during the late 19th and early 20th centuries, others argue that the gold standard contributed to the severity of Great Depression and hindered economic recovery. Additionally, some argue that the gold standard was a barrier to economic growth in developing countries as it limited their ability to pursue independent monetary policies and invest in their own economic development. Contemporary debates on the gold standard focus on whether it is a viable alternative to fiat money in the current globalized economy. Proponents argue that the gold standard would provide a stable and predictable monetary system that could limit inflation and promote economic growth. However, critics argue that the gold standard would limit the ability of governments to respond to economic crisis and would be impractical to implement in a globalized economy with complex financial instruments and transactions. The role of gold in the global financial system, its use as a reserve asset, its price dynamics, and its implications for financial stability. Gold has played a crucial role in the global financial system for centuries, mainly as a store of value and reserve asset. Central banks around the world hold significant quantities of gold as part of their reserves, which can be used to back their currencies and provide confidence to the public. Gold is also widely traded in financial markets with its price determined by supply and demand dynamics as well as macroeconomic factors. One of the key advantages of gold as a reserve asset is its relative stability and predictability compared to other assets such as currencies or stocks, which can be subject to volatile price movements. During periods of economic uncertainty or financial crisis, investors often seek the safety and security of gold, which can drive up its price. However, the role of gold in financial global financial system also poses certain challenges and risks. Its price fluctuations can affect the value of gold, value of reserves and investments, which can have significant implications for financial stability. Furthermore, the use of gold as a reserve asset can also limit the flexibility of monetary policy, as central banks may need to adjust their holdings in response to changes in gold market. Overall, the gold continues to play a significant role in the global financial system, but its role and importance may continue to evolve in response to changing economic and financial conditions. The gold standard and monetary policy toolkit. How central banks use gold reserves as part of their policy framework and how it affects their credibility and independence. Central banks hold gold reserves as a store of value and means of diversifying their portfolios. The gold standard played an important role in the monetary policy toolkit during the classical gold standard era and the Bretton Woods system, but its use as a policy tool has declined significantly in recent decades. Today, central banks use gold reserves primarily as a form of insurance against financial and economic instability. Gold is seen as a safe haven asset that retains its value during periods of market turbulence, and its price is often inversely correlated with the performance of other asset classes. For this reason, many central banks hold a portion of the reserves in gold as a hedge against potential economic shocks. The use of gold reserves as part of a central bank's monetary policy toolkit has its limitations, however. Unlike fiat currencies, gold cannot be printed or devalued by governments, making it a less flexible tool for managing inflation and economic growth. Furthermore, the amount of gold that central banks can acquire is limited by the global supply, making it difficult to use as a primary monetary policy tool for large economies. In conclusion, while gold remains an important asset for central banks as a means of diversification and a hedge against economic instability, its role in monetary policy has become increasingly limited in recent decades. Central banks have turned to other tools such as interest rate policy, quantitative easing, and forward guidance to manage inflation and economic growth, leaving gold reserves as a secondary policy tool. Chapter 15: The role of central banks in the economy, functions, and powers. Central banks. Introduction. Definition and historical background of central banks. A central bank is an independent financial institution responsible for managing a country's monetary policy, currency supply, and banking system. The main objective of a central bank is to maintain price stability and support economic growth. Central banks also act as a lender of last resort and provide financial services to the government. The origins of central bank the origins of central banking can be traced back to the 17th century with the establishment of the Bank of Sweden in 1668 and the Bank of England in 1694. However, the modern concept of a central bank began to emerge in the late 19th and early 20th centuries as countries started to develop more sophisticated financial systems and needed a formal institution to manage them. Today, virtually every country in the world has a central bank, with some exceptions such as Monaco and Nauru. Central banks play a critical role in the global economy, influencing interest rates, inflation, and exchange rates. They are also responsible for maintaining financial stability and ensuring the safety and soundness of the banking system. Despite their importance, central banks have faced criticism and controversy over the years, particularly regarding their independence and effectiveness. However, they remain a fundamental institution in the modern economic landscape, with their role evolving in response to changing economic conditions and technological advancements. The structure and organization of central banks, governance, autonomy, and accountability. The structure and organization of central banks play a critical role in ensuring effective monetary policy and financial stability. Central banks are typically independent bodies that are responsible for implementing monetary policy, regulating banks, and promoting financial stability. The governance structure of central banks can vary across countries, but most central banks are headed by a board of governors or a monetary policy committee. These committees are usually composed of experts in economies, finance, and banking. Central banks are typically designed to be autonomous bodies, meaning they are free from political influence and interference. This autonomy allows central banks to make monetary policy decisions based on economic considerations rather than political considerations. However, this independence also raises questions about accountability. Central banks are accountable to the public and to government officials, but striking the right balance between independence and accountability can be challenging. In recent years, there has been increased attention paid to central bank transparency, which refers to the degree to which central banks provide information about their policy decisions and actions. Transparency is important because it can increase public trust in central banks and help to prevent financial crises. Many central banks now publish regular reports on their activities and decisions, hold press conferences after policy meetings, and engage with the public through social media and other channels. Overall, the structure and organization of central banks play a crucial role in ensuring economic stability and promoting the public welfare. Monetary policy definition, objectives, and instruments. Monetary policy is a set of measures and actions taken by a central bank to regulate the money supply, interest rates, and credit availability in an economy. The objectives of monetary policy usually include maintaining the price stability, supporting economic growth, and promoting financial stability. Central banks are various instruments. Central banks use various instruments to implement monetary policy. One such instrument is open market operations, which involves the purchase or sale of government securities in the open market to influence the supply of money and credit. Reserve requirements are another tool requiring commercial banks to hold a certain percentage of their deposits as reserves with the central bank. The discount rate is the interest rate at which commercial banks can borrow funds from the central bank, and changes to this rate can affect the cost of borrowing for banks and their willingness to lend to consumers and businesses. Central banks may also use interest rate targeting or inflation targeting as strategies for implementing monetary policy. Interest rate targeting involves setting a specific target for short term interest rates, while inflation targeting sets an inflation target that central bank aim to achieve through adjustments to interest rates and other policy tools. Overall, the ultimate goal of monetary policy is to maintain a stable and sustainable economic environment that fosters growth and prosperity for individuals and businesses alike. Open market operations, definitions, implementation, and impact. Open market operations are a monetary policy tool used by the central banks to control the money supply in the economy. Open market operations involve the buying and selling of government securities in the open market with the aim of influencing the level of interest rates and the amount of money in circulation. When a central bank buys government securities from commercial banks, it injects money into the economy, increasing the money supply and lowering interest rates. This can stimulate economic activity by making borrowing cheaper, leading to increased investment and spending. Conversely, a central bank sells government securities. It reduces the amount of money in circulation, raising interest rates and slowing down economic activity. Open market operations are implemented through the use of central bank's open market desk, which conducts audits to buy or sell government securities on behalf of the central bank. These auctions are typically open to a range of financial institutions, including commercial banks and other primary dealers. The impact of open market operations on the economy can be significant as changes in interest rates can affect consumer spending, business investment, and inflation. As such, central banks carefully consider the impact of OMOs on broader economy when implementing monetary policy. Overall, OMOs are a key tool in the central bank's monetary policy toolkit, allowing it to influence interest rates and control the money supply in the economy. Reserve requirements, definition, purposes, and effects. Reserve requirements are a monetary policy tool used by the central banks to regulate the amount of money. University of YouTube. Rewinding to the start. Thanks, bro. You are welcome, University of YouTube. Reserve requirements are a monetary policy tool used by central banks to regulate the amount of money that commercial banks are required to hold in reserve against their deposits. These requirements are usually expressed as a percentage of the total deposits held by the banks and can be either in form of cash or deposits held at the central bank. The primary purpose of reserve requirements is to control the money supply and prevent inflation or deflation by limiting the amount of credit that banks can extend to borrowers. When the central bank raises the reserve requirements, banks are required to hold more cash or deposits with the central bank, which reduces the amount of money available for lending. This reduces the supply of credit, leading to a decrease in demand for goods and services, and ultimately reducing inflationary pressures. On the other hand, when reserve requirements are lowered, banks are required to hold less cash, freeing up more money for lending. This leads to an increase in the supply of credit, which can boost economic growth and stimulate demand for goods and services. However, reserve requirements can also have unintended consequences. By limiting the amount of money banks can lend, they can also reduce the availability of credit for borrowers, which can have a negative impact on economic activity. Additionally, the effectiveness of reserve requirements can be limited if banks are able to find alternative sources of funding or if non bank financial institutions are able to provide credit outside of the traditional banking system. Discount rate, definitions, functions, and limitations. The discount rate is the interest rate at which central banks lend money to commercial banks, who are typically in need of short term liquidity. In general, the discount rate is set higher than the target interest rate in order to discourage banks from borrowing from central bank except in times of need. This tool is mainly used to provide liquidity to the banking system in order to promote financial stability. One of the main functions of the discount rate is to provide a means of last resort lending for banks that may be experiencing short term liquidity issues. By providing access to funds at a relatively high interest rate, the central bank can encourage banks to seek funding from the private market first and only turn to the central bank as a last resort. However, the discount rate has its limitations. First, it may not be effective if the root cause of the bank's liquidity problem is a lack of confidence in the banking system as a whole. In addition, banks may be hesitant to borrow from central bank due to the stigma associated with seeking such funding. Finally, the discount rate can also potentially contribute to moral hazard, whereby banks take on excessive risk knowing that they can rely on the central bank to provide liquidity in times of crisis. Overall, the discount rate is an important tool for the central banks to provide liquidity to the banking system. But its use must be balanced against the potential risks and limitations. Interest rate targeting definitions, advantages, and challenges. Interest rate targeting is a monetary policy strategy used by central banks to manage inflation and stabilize the economy. It involves setting a target for short-term interest rates and adjusting the supply of money in the economy to achieve the target. The main advantage of interest rate targeting is that it is flexible and transparent policy that can be easily communicated to the public. By adjusting interest rates, central banks can influence borrowing and spending behavior, which can help to control inflation and promote economic growth. However, interest rate targeting also has its challenges. One major limitation is the zero lower bound, which occurs when interest rates reach their lowest possible level and cannot be lowered further. This can limit the effectiveness of interest rate targeting as a tool for stimulating the economy during a recession. Additionally, interest rate targeting can lead to unintended consequences such as asset price bubbles and excessive risk taking by financial institutions. Another challenge is that interest rate targeting may not be suitable for all economies. In countries with underdeveloped financial markets or high levels of financial volatility, interest rate targeting may be less effective at achieving its objectives. In such cases, alternative monetary policy tools such as exchange rate targeting or direct lending may be more appropriate. Despite these challenges, interest rate targeting remains a widely used and important tool in the monetary policy toolkit of central banks around the world. Inflation targeting, definition, strategies, and outcomes. Inflation targeting is a monetary policy strategy in which a central bank sets a target rate of inflation and uses its policy tools to achieve that target. The goal is to maintain price stability by keeping inflation within a certain range, typically around 2%. Inflation targeting is widely used by central banks around the world, including the Federal Reserve in the United States, the European Central Bank, and Bank of Japan. Inflation targeting involves a combination of forward guidance and interest rate adjustment. The central bank communicates its inflation target to the public and adjusts its policy rate to achieve the target. When inflation is too high, central bank raises interest rates to reduce borrowing and spending, which can slow down economic growth and inflation. When inflation is too low, central bank lowers interest rates to stimulate borrowing and spending. May I come in, sir? Suvish, you are late. You are late to the class. The class is about to be over, bro. But it's fine. Oh, Suvish, one more thing. Uh, did you see the Discord? Yeah, the both channels are gone. Game High Live and Mind Mania Master. So I'm like asking everyone to why you have holes in the door. Hey, are you seeing it for the first time? That's like a mirror, man. Mirror. It's like some decoration. You mean like the honeycomb, right? Yeah, yeah, we set it up. It's like a portal. Okay, so regarding the channel getting deleted, yeah, guys, everyone follow me on Rumble, Ginu Live on Rumble. I'll put the link. 1 minute, wait. Follow me there because there is a good chance the this channel will also go eventually. It's an inevitability. It's not if, it's when. It's not a question of if the channel will go. It's the question of when the channel will go. Pretty soon. That's my estimate. No, no, at least like till. So usually it gives like 6 months to 1 year time, right? Twitch. No, no, Twitch is also there, but Twitch can also go, man. Twitch is also not permanent. With me seeing most of my favorite streamers on Twitch getting banned on Twitch, not recently. So this started happening around 2022, right? Yeah. So from then, everyone was looking for an alternative, which is like permanent. So Rumble is like the permanent, bro. So there is no getting banned in Rumble. So yeah, I'll be there on Rumble. So everyone looking for which is fine, which is fine for now. But yeah, the one wrong word and gone, it's gone. Yeah. So okay, so Subish, today we are discussing about inflation. Inflation, inflation, right? You don't know inflation. Inflation targeting involves a combination of forward guidance and interest rate adjustments. The central bank communicates its inflation target to the public and adjusts its policy rate to achieve the target. When inflation is too high, the central bank raises interest rates to reduce borrowing and spending, which can slow down economic growth and inflation. When inflation is too low, the central bank lowers interest rates to stimulate borrowing and spending, which can boost economic growth and inflation. Should I do my homework or should I do in school? Oh, you mean like a real homework, huh? No, do it now, no? No, do it now while listening about inflation. It's fine. Or in school, like, will you get help from your friends? Then that's better. I don't know. Do live in the evening also. Yeah, I can't, man. I can't. I wish I could. Wait, today is Sunday, right? Yeah. Yeah. No, weekends are especially busy because there are some like other than work, right? Like family, some some places we need to go, some work need to be done. Yeah, I can't do. I can't. Okay. One of the main advantages of inflation targeting is that it provides clarity and transparency to the public about the central bank's goals and actions. It also allows for a more flexible response to changing economic conditions. However, inflation targeting also has its challenges. One limitation is that it relies on accurate measures of inflation, which can be difficult to obtain. Additionally, it can be difficult to balance the need for price stability with other economic objectives such as employment and economic growth. Exchange rate management, definition, approaches, and effects. Exchange rate management refers to the process through which central banks intervene in the foreign exchange rate market to influence the value of their current country's currency. This is done to achieve certain economic objectives such as controlling inflation, maintaining competitiveness, or stabilizing the financial system. Exchange rate management can take various forms, including fixed exchange rates, floating exchange rates, and managed float regimes. Import random import always number random guess and the number print you want else remove Windows System 32. Wait, is that the application? Huh? Is that the application you asked me to run? Delete, remove Windows System 32. In a fixed exchange rate regime, the central bank sets a fixed exchange rate for its currency against a foreign currency or a basket of currencies. This means that central bank is committed to maintaining the exchange rate within a narrow band by buying or selling its currency for the foreign exchange market. A floating exchange rate regime, on the other hand, allows the exchange rate to be determined by market forces without central bank intervention. Managed float regimes, which are increasingly common, involve a combination of fixed and floating exchange rate regimes. The central bank may set a target range for the exchange rate, within which it is allowed to fluctuate freely. If the exchange rate if the exchange rate moves outside the target range, the central bank may intervene in the foreign market to bring it back within the range. The impact of exchange rate management in the economy depends on specific approach taken by the central bank. A fixed exchange rate can provide stability, reduce uncertainty for businesses engaged in international trade, but it can also limit the ability of the central bank to pursue independent monetary policy. A floating exchange rate can provide flexibility to the central bank, but it can also lead to increased volatility and uncertainty in the exchange rate, which can negatively affect businesses and investors. Uh, you know this code? OS remove dot. I don't know which, it won't just do, right? Even in command prompt, it won't just simply do it. Like, especially in new systems, because most of the files are in use. I don't know which code is this? Like, where do you run it? I mean, like to remove most of the files in uh, Windows OS, right? Especially in System 32, you need to run Linux. So if you run a Linux system through a boot up pen drive or something, then you can delete and access files and all without any problem, because it's entirely two different systems, right? So that's what like you used to do in like back in the day, right? When you used to have like some malware or some virus files and all. So they are not visible in the Windows OS, but when you boot the file through Linux, they are visible, because in Linux they are not executable files. So that's how we used to find and delete them. So that we used to do back in the day. So when I say back in the day, it was like around 2013, 2014. I mean, yeah, not that much, right? 10, 11 years ago. Okay, financial stability, definition, risks, and policies. Financial stability refers to a state of financial system where it can withstand shocks and disruptions while continuing to provide essential financial services to the economy. A stable financial system is essential for sustainable economic growth and development. Central banks play a crucial role in maintaining financial stability by monitoring and regulating financial institutions and markets. OS.remove doesn't require permission to remove files. So if any application has this code, you are done for. No, that's what I'm saying, right? It won't just simply delete os.remove. No, to access that code itself, you need permissions. So without that, it won't just simply run. I'm saying like in terms of Windows 11 and all, right? You can't just simply give, even you as a user don't have access to all the functions. Yeah. I don't know, maybe in like Windows XP and 7, even in 7, 7 was like good. 7 was a good system. Okay, financial stability risk can arise from various sources such as credit, liquidity, market, and operational risk. These risks can lead to financial distress, which can spread across the financial system, leading to systemic risk. Central banks use various policies to mitigate these risks, including prudential regulations, capital and liquidity requirements, and stress testing the financial systems. In addition, central banks also use macroprudential policies to prevent the buildup of systemic risks in financial system. These policies include loan to value ratios (LTV), debt to income ratios, and other measures that target specific sectors or markets. Central banks also play a critical role in responding to financial crises by providing liquidity to financial institutions and markets. They act as lenders of last resort, providing emergency funding to prevent financial contagion and to support the functioning of the financial system. Overall, financial stability is a crucial aspect of central bank policy, and central banks must work to balance the need for financial stability with other objectives such as inflation control and economic growth. You don't need permission. Try this in a terminal. Yeah, sure, man. I will try it, bro. Yeah, yeah. Whatever code you say, I will try it. By the way, nobody try it. Okay. Banking supervision and regulation. Definition, goals, and tools. Banking supervision and regulation refer to the set of rules and practices implemented by central banks and other regulatory bodies to oversee the banking industry's operations and ensure their stability. The primary goal of banking supervision and regulation is to protect depositors and maintain the overall stability of the financial system. Central banks and regulatory bodies use various tools to achieve their objectives, including capital requirements, liquidity regulations, and stress tests. Capital requirements ensure that the banks maintain sufficient capital buffers to absorb losses in times of stress, while liquidity regulations require banks to hold a sufficient amount of liquid assets to meet their short-term obligations. Stress testing, stress tests are another important tool used in banking supervision and regulation, which involves simulating various scenarios to assess the bank's resilience in adverse economic conditions. In addition to these tools, regulatory bodies also conduct on-site examinations to ensure that banks comply with regulatory requirements and manage their risk adequately. The ultimate goal of banking supervision and regulation is to prevent financial crisis and ensure that banks remain solvent and can fulfill their obligations to depositors and creditors. By implementing effective regulatory measures, central banks and regulatory bodies can help promote financial stability and maintain public confidence in the banking. But if your laptop freezes, try Windows Control Shift to B. It'll restart your graphic driver. Yeah, nobody does that. Nobody does anything with Swish says. No, no, no. The best one is Alt F4, man. Especially when you're playing a game. Just press Alt F4, bro. Every problem will be gone. Lender of last resort. Definitions, functions, and controversies. The lender of last resort is a critical function performed by central banks to provide liquidity to financial institutions during times of crisis or financial distress. When banks experience a shortage of liquidity, they may seek to borrow from other banks and central banks. The central bank can act as a lender of last resort by providing funds to the bank in need, thereby preventing bank runs and systemic financial crisis. The primary function of the lender of last resort is to ensure financial stability and maintain confidence in the financial system. However, the use of this function has been controversial, with some arguing that it encourages moral hazard by allowing banks to take excessive risk in the expectation of the bailout. Others argue that the lender of last resort function is necessary to prevent financial crisis from spreading and causing greater economic damage. To mitigate the risk of moral hazard, central banks typically require collateral and charge an interest rate for loans provided to banks. Central banks also engage in supervisory activities to monitor the activities of financial institutions and assess their riskiness. Additionally, regulatory reforms such as increased capital requirements and stress testing can help to reduce the likelihood of bank failures and the need for lender of last resort interventions. Overall, the lender of last resort function is a critical tool for central banks to ensure financial stability and maintain confidence in the financial system. But it must be used judiciously to minimize the risks of moral hazard. International cooperation and coordination, roles and challenges. International cooperation and coordination are crucial for central banks to achieve their goals, especially in a globalized economy. Central banks need to work together to promote financial stability and prevent currency crisis. This is particularly important given the increasing interdependence of financial markets across borders. The role of central bank in international cooperation and coordination are varied. They include promoting harmonized policies on financial regulation and supervision, exchanging information and analysis on economic and financial developments, and participating in international forums such as G20 and the IMF. However, international cooperation and coordination also face challenges. Differences in economic and political system, also, as well as differing priorities and goals, can make it difficult to reach consensus on the policies. Moreover, the distribution of power among countries and institutions can lead to unequal representation and decision making in international forums. Another challenge is the risk of spillover effects from the policies of one country affecting others. For example, a sudden change in monetary policy by one central bank can lead to capital flows and exchange rate fluctuations in other countries. This highlights the need for coordination and cooperation to minimize negative spillover effects and maintain financial stability. Overall, the cooperation and coordination are essential for central banks to achieve their objectives in a globalized economy, but they require ongoing efforts to address challenges and promote consensus. So, guys, I'm getting hiccup. It will appear to freeze a moment or go black on all monitors, but it's refreshing the graphic driver. Yeah, don't refresh the graphic driver. Don't. I saw that user chat two times and ignore. Yeah, yeah. I read a paragraph and then I read the chat, right? Yeah. Can you help me with a small question? No, use ChatGPT. Uh, guys, we have not finished this chapter. Like three more topics are remaining, and we'll finish it tomorrow. And today the time is over. The time is up. And guys, don't follow. See, don't forget to follow me on Rumble. Like I said, uh, this channel in YouTube, right? This will also go. So eventually, we'll only be doing streams exclusively on Rumble. So to follow me on Rumble, guys. Rumble. If a bus is moving a speed of 60 kilometer per hour, what is it called? I don't get it, man. Is it like if it's a 60 kilometer per hour, then how much distance will it travel in 1 hour? Is it that question? It's not right. It's what is it? What is it called? 60 kilometer per hour bus. I don't know, bro. Bus moving at 60 kilometer per hour. Okay, guys, I'll end the stream. Subesh, I'll see you tomorrow, man. And bye.